Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra and this is the earnings special edition, and our focus today is on KPIT Technologies. The company has reported its earnings for Q4. On a sequential basis, a marginal rise in the net profit at 164.3 crores is what we've seen. Also, as far as the top line is concerned, again sequentially there's a 5% jump to 1321 odd crore rupees. Remember, on a year-on-year basis, there has been a substantial jump on both these fronts. On the profitability factor, you've seen a 49% jump in the March quarter net profit, and on the top line front, we've actually seen a 30% increase as well. Again, on a sequential basis, when we look at the kind of EBITDA, that's increased 5.7% to 277 crore rupees, and the margins have stood at 21%. To detail for us some more key fine print from the earnings and insight as to what could be the future looking like for the company, I'm now joined by the top management of the firm. The co-founder and the joint managing director, Mr. Sachin Tikkekar, is with us. Good morning to you, sir. Thank you so much for taking the time out for this discussion. Good set of numbers for you. Do tell me, are you pleased with the numbers? There could be some more things that you could have achieved in this quarter. How do you assess the Q4 numbers, and where do you see things panning out now?
All right. Good morning to you, and thanks for having me. We'll take one question at a time. We are very pleased to report our numbers with Q4, for the Q4 as well as for the financial year 24. Very happy to say that we beat our revised guidance for the year. And, it was supposed to be 37% plus. We touched almost 40%. So very happy with how the growth panned out during the course of last year. And it actually happened on the back of 37% year-on-year growth in the previous year. So last few years have been very solid. To work with handful of clients, some of the global OEMs on the passenger car side as well as on the truck side. And bulk of the growth has been driven by the same set of clients. So we've been able to go deep and wide in all our relationship with our clients. And that has been our strategy. And we are happy to see that the strategy is unfolding really well, not only for our clients, but also for us and our employees. Specifically about Q4, the Q4 performance was slightly better than what we thought it would be at the end of Q3. We are also starting the new year on a fairly sound pipeline in terms of the carry forward business that we'll have from the previous year and some of the new engagements that we see that will sort of unfold over the next couple of quarters. So all in all, given what's going on across the world, and not just in the geopolitical way, but also with the automotive and technology sectors, we just feel lucky to have this kind of a visibility at this point in time.
Absolutely, and I did want to actually come to the demand scenario part to understand from you geographically how the demand trends are shaping up for you, especially with the shift really taking place worldwide, especially in India with respect to more EVs in automotive sector and more hybrid technologies. How do you really see the demand scenario panning out, sir?
It's looking good. In the sense that, of course, there is a tremendous pressure from the consumers. And if you look at the big pockets of the world where vehicles are sold, if you look at Europe, there is very little growth, if at all any growth in Europe. In US surprisingly continues to beat the expectations. So, but the growth rate has slowed down, generally speaking. The growth rate in China, in terms of the number of vehicles sold, has also slowed down. So India is the market to really look at. You looked at the 2023 numbers for the year, the number of vehicles sold in India, very impressive. And it looks like over the next 5 to 7 years, India will drive the growth. So overall, if you, and to your point about electrification, there are different parts and there are different types of what we call propulsion, the way to sort of provide energy to the vehicle. So your traditional way has been internal combustion engines. I think they continue to live on. especially in trucks and some of the larger vehicles. Secondly, there is shift towards what you will call BEV, which is battery electric vehicles that run 100% on batteries. And now you hear more and more about hybrid, which is in between. You not only have the internal combustion engine, but you also have set of batteries. And then there are different types of hybrids. There are plug-in hybrids that have larger battery and a smaller engine, and vice versa. So and different car makers for different market take a different view of. So every OEM has multiple programs in terms of how they want to power the vehicle, which is good news for a company like KPIT and also for the consumers, because all their preferences can be met. So in general, from the propulsion side, the demand continues to look fairly robust for KPIT, in spite of some of the headwinds that are being faced due to geopolitical issues, not only because of the couple of wars that we have on our hands, but also the prominence of the Chinese car makers, who are putting tremendous pressure on all the other global OEMs in terms of the cost, features, and just the quality part. So, in short, the market continues to be fairly dynamic. In spite of the headwinds, we think that we are on a sound ground at this point in time.
Right. So, but you've also given and announced the guidance for the new fiscal of 18 to 22% growth on the top line, and the profit margin number at 20.5%. Why is there then conservation in terms of the numbers that you've put here?
The way we provide guidance is what we already have, the business that will get forward, and then, what kind of growth which is visible to us. Based on that, we believe 18 to 22% is possible. If there is likely to be any revision, typically we make the change at the end of Q3. But till that time, we really want to just focus on getting it done. If you look at the guidance that has been given by other ER&D companies or IT companies, we have not heard of anybody providing guidance in the double digits. So from that perspective, we look like we seem from our perspective, I think the visibility seems a lot more. And on the bottom line side, of course, if there is going to be 18 to 22% growth, one would expect the EBITDA also to go up. The only reason you don't see much year-on-year growth in EBITDA is because we have come out with a stock option scheme for our employees. We believe it's the right thing to do from the long-term perspective. So in spite of, and that would have a substantial impact during the course of the year, possibly to the tune of 1.5%. So this is important investment from our side for our employees. So in spite of that, we'll see margins being maintained, if not going up a little bit.
Okay. Got that. Apart from this, sir, if you could also help us understand when it comes to the deal wins, the total contract value of total deals won for the quarter was at $261 million. How do you see the momentum going forward from here, and what could be the exit value that you could look at in FY25?
Okay. We are very happy to see the growth in the pipeline from last year coming during the course of last year, especially from Q3 of last year to Q4. Most of the value that you just mentioned, in excess of $250 million, it's from our existing clients. 80% of it is actually on the back of only 6 specific engagements. And that sort of, to your earlier question, that also gives us reasonable confidence of having that 18 to 22% growth in the year. We believe that if you take a midterm view, you look beyond FY25, let's say FY26, 27, we remain fairly bullish. What happens is, there are many production programs for cars get started, and there is a sharp ramp up to deliver on those programs. So it's kind of a wave. If you look at us in H1 of last year, our business went up substantially. Comparatively, it was not as much. in H2. So we believe that H1 is also, it started to pick up. So we do believe that the H2 of this year can be stronger than the H1. And we hope that the wave continues for another couple of years. And our hope is we'll end up with a pipeline which is stronger than the current one at the end of this financial year.
Okay, got that. So as far as, the verticals and the segments are concerned, where do you see the driving factors going forward in FY25? What levers could you be betting on to improve the growth on the margin front as well going forward, sir?
From our business, bulk of more than 70% of our business comes from passenger cars, and about 25-26% comes from trucks. So those are the only verticals or sub verticals within the industry of mobility that we have. This year we will make investments to also get into an adjacency of industrial and farm equipment. Again, the technology that we have for pass cars and trucks, to the tune of 70-80% is applicable for farm equipment as well. So we believe that there is a lot of leverage that we can have, so that we can also, that becomes sort of over a period of time, the IFE, the industrial and farm equipment sector also becomes a growth driver for us. So that's additional adjacency we are adding to trucks and passenger cars during the course of this year. Secondly, we are also looking at China and learnings from China that can be made applicable to our global OEMs. So learnings from China. These are the two strategies that we are sort of working on, and we believe that that's one market that we have not tapped, especially post the pandemic. That can also be a growth driver for us over the next 3 years. So this is how we really look to see driving our top line in the midterm. You take a view of another 3 to 4 years. From margin expansion perspective is when you have a healthy growth of upwards of 15-20%, that kind of naturally gives you a little bit more leverage to increase your margins. But going forward, we are doing what we call more of platforms, tools, and accelerators. That means we can do little more licensing to our clients rather than just purely services. That helps them to short their time to market, and it's more cost effective for them. And it also means better margins for us. So that's another lever that will play out over the next 2 or 3 years from KPIT's perspective.
All right, sir. Well, many thanks, sir, for joining us on Business Today and helping us understand the key insights from the earnings and the outlook also going forward. All the very best to you for the upcoming quarters as well. And we shall hope to catch up again to understand more industry trends and the vision of the company going forward from you.
Thank you so much. Thanks for having me.
Thank you so much, sir, and all the best. All right, viewers, we will wrap it up at that. The conversation with Mr. Sachin Tikkekar, the co-founder and joint MD of KPIT Technologies. There could be some more uncertainty when it comes to the demand sluggish that we are looking at right now, but definitely the company feels that they are on a strong ground, and they do have a vision of the next 3 to 4 years perspective to continue to grow in double digits and also to sustain the margins above 20% odd or so. So we'll continue to look at all the factors that continue to govern the automotive space as well as the auto tech companies like KPIT Technologies for you to have a better understanding of this space as well. Until then, many thanks for joining us, but do stay tuned as at 12 noon I will be coming back with Daily Calls, which is your favorite show which addresses all your stock related queries as well, and top market experts are there to solve your queries live on the show as well. So don't forget to write into us on the WhatsApp channel as well as on the YouTube platform as well. Many thanks.